All right, we're live. Good afternoon, everybody. My name's Ryan Dillon. I'm a financial planner here at Secured Retirement. Stepping in for Joe Lucey today. He is off at an educational seminar, so he regrets he can't be with you today. But he's gaining knowledge and always learning about the constant changing financial world. We have a great show for you today. We have a special guest, Andy Ives. He is a certified financial planner. He is an accredited investment fiduciary, and he is an IRA analyst with the Slott and Company. Great friend of ours. Joe's been a longtime partner of the Slott Group. Tremendous people to have in your back pocket. Going to kick it off today. We'll get started. This might be a little bit shorter of a webinar for you today, but jam-packed with pertinent information on, as you know, tax time is coming up. You heard, and Andy's going to get into this a little bit. The deadline got extended to May 17th, so we got a little bit of extra time. But these are things he's going to talk about that you should be reviewing with your accountant. Go through a little bit of compliance items for us here. Again, information on this show is subject to change without notice. Any type of investing involves risk, including the loss of principal, and there are no guarantees. Our firm does not assume any liability of loss, which may result in such information and opinions. Again, we're going to be talking about taxes today, and everything should be well thought out and asked with your accountant. We are not tax professionals. We do spend a lot of our planning process in the tax world, but again, you always want to get confirmation with your accountant in that regard moving forward, as always. So I'm going to kick it off to Andy here. Again, great partner of the show. He's a CFP, he's an AIF, and Andy, take it away. Thank you for being here today.
All right, thank you, Ryan. I do appreciate it. This is it is crazy tax time now, and I say crazy tax time because we've been through so much. Everybody has over the past 12, 13, 14, 15 months. We've had the Secure Act, we've had the CARES Act, we've had the pandemic, we've had stimulus checks, we've had unemployment changes, we have all kinds of things going on. And what's crazy to me is that bottom box on that page. It says these are the first tax returns being filed after both the CARES and Secure Acts. It seems to me like the CARES Act and Secure Act were passed so long ago, but they're still just last year. So this is the first tax season, and a lot of people are dealing with the changes that are going on. So as Ryan mentioned, of course, that first bullet point, the IRS has extended the 2020 tax filing deadline to May 17th of 2021. That is, of course, a welcome break for a lot of people because of what it says over there in the highlighted portion in yellow on the right-hand side of the screen. This is becoming one of the most complicated tax seasons in decades. That tax filing deadline is for federal taxes. I did look it up, and I saw that Minnesota had also, from a state tax perspective, had also extended their tax filing deadline for the state to May 17th. But it's going to vary from state to state to state. So depending on where you reside, be careful, because state and federal do not always coincide with each other. And there's Oklahoma, Texas, and Louisiana. They actually extended their federal tax filing deadline to June because of the storms that were down there. So every state is different as far as federal, state. So just know what your dates are. With that extension, that federal extension, the IRA contribution deadline is also extended to May 17th, meaning if you want to make a prior year contribution, you can still do so up until the tax filing deadline. I know there's been some misinformation out there, some confusion around that. It is May 17th for a prior year contribution. Be careful with that. A lot of the programs that these custodians have when you make a contribution, and if it's after April 15th, which is the standard deadline, the system will automatically code it as a current year contribution. So if you do something between April and May 17 and you want it to be for a prior year 2020, make sure that it's coded properly, because it could get missed just because of the way the systems are set up. On the next slide, speaking of IRA contributions, a lot of people miss this opportunity. Just because a spouse is not currently employed does not mean that that spouse cannot contribute to an IRA if his or her spouse is working. So as long as you file jointly and have earned income, both spouses can contribute. You can do a spousal contribution for the non-working spouse. Now, it says that right here, the third bullet point, the non-working spouse can make a contribution based on a working spouse's earned income. Now, the fourth bullet point in boldface there, I don't want it to be misleading. We had questions on this bullet point. This presentation, we gave this similar presentation last week to all the Slott advisors across the country. I clipped out the pertinent slides that I thought would be most valuable for today. This one bullet point raised some questions, and maybe it wasn't written well, but it says stay-at-home parents and full-time caretakers of elderly family members can make spousal contributions if they are married and file a joint tax return. You don't have to be a parent. You don't have to be a caretaker of an elderly family member. Those are just examples that were included that said, hey, if you happen to be one of these people that just happens to stay at home and doesn't have quote unquote earned income, you can do a spousal contribution. Doesn't matter if you're a parent or not. You just have to have another spouse that has earned income, even if they work part-time. If you have combined joint earned income, you can do a spousal IRA contribution. The last bullet point, it says if the non-working spouse later has earned income of his or her own, they can then make regular IRA contributions to the same IRA. You don't have to set up a separate IRA and call it your spousal contribution IRA. That's not necessary. You would just make the same contributions to the same IRA that you have. It would just be based on the fact that it's off of your spouse or your joint combined earned income. So that's why that slide is on there. A lot of confusion on spousal contributions and the fact that people miss that on their taxes. Hopefully that's an item that people will see the light bulb will go on, and it'll be an opportunity for them to potentially reduce income. So what is compensation? If you're going to make an IRA contribution, you've got to have compensation. A bunch of questions have come in about this based on changes and things that we've seen over the past year. So there's some items there on the left-hand side. You received a stimulus check. So if that's all you received last year, does that qualify for an IRA contribution? It does not. A stimulus check does not qualify as compensation for an IRA contribution. Second bullet point, you lost your job during the shutdown and took a coronavirus-related distribution. I'm going to talk about these in a little bit, how you might be able to leverage the CRD rules. But in this case, if that's all you did was take a coronavirus-related distribution from your IRA, does that count as earned income and potentially qualify you for contributing to a Roth IRA or a traditional IRA? It does not. Nor does the last one. I think we have a number of retirees on this call, so this probably doesn't matter in your situation. What about the person who received unemployment benefits? If that's all they received, in this case, it says after her business was shuttered due to the pandemic, do those unemployment payments count? They do not. So on the right-hand side of this page is a chart, compensation and not compensation, and it lists a number of different things on there. It is a dynamic chart. There's a couple of things that are circled on there: scholarship or fellowship payments, difficulty of care payments. Those are brand new under the Secure Act. So there's a constant review of what qualifies as compensation for IRA, what does not qualify as compensation for IRA contributions. So be aware before you go ahead and just plop money into an IRA and think you have earned income. Be aware what qualifies, or else you're going to be stuck with potentially an excess contribution. I know some employers can be creative with how they compensate people. Look to the W-2. If you're not sure, look at the W-2, see what's in that box, in that top box that says earned income. That should be the driver of whether or not you can contribute to an IRA. Okay, next slide is, this is something that I think will apply, or let me rephrase, does apply to a number of retirees. And another thing to think about when it comes to this tax season. 2020 RMDs, yes, they were waived. We know that 2020 required minimum distributions were waived from IRAs and from plans. However, did you voluntarily or accidentally take an RMD or a normal distribution in 2020? Second bullet point, was an RMD forced out to you? And it could have been. There are like 401k plans that even though RMDs were waived, these plans did not have to abide by that. They could have forced out an RMD payment. Now, once that payment was in your hand, you could have certainly abided by the CARES Act that said that RMDs were waived and put it back. You could have rolled it back into the plan or maybe to an IRA and not have to pay the taxes on that. But the plan certainly could have forced it out upon you. Now, If you did take a distribution, let's say early last year, and you didn't put it back, you had time. If you remember the rules last year, you had up until August 31 to get it back. They waived or they extended the 60-day rollover rule. Let's say you took an RMD after that. Let's say it was set to automatically pay out to you and you received the distribution in, say, September or October, and you still have that in hand. There's a way to get that back, even though we are well beyond the 60-day rollover period. How do you do it? Look at that third bullet point. You can deem the 2020 withdrawal as a CRD, a coronavirus-related distribution, if you were an affected person. I'm going to talk about that next, what an affected person is. But for those that weren't familiar with CRDs, it allows a person, any person, to take up to $100,000 out of their IRA or plan. They avoid the 10% penalty if they're under 59.5, and they can pay it back at any time within 3 years. They can also spread the tax on that over 3 years if they want to, spread the income over 3 years, but we're not going to talk about that here. So that's the gist of a CRD. Allows a person access to 100 grand. If a person took a distribution last year and they want to put it back, but they forgot to, they're past the 60 days, they could say, hey, that was a CRD, and now I have 3 years to put it back. I'm going to put it back, and I'm going to eliminate that income from my taxes for this year. The IRS has confirmed just a week and a half ago, on the 16th, that that is an eligible strategy. Now, how do you know you're an affected person? That's on the next slide here. So this is way back when the CARES Act came out, back in March of last year. They identified the people that are allowed to take a coronavirus-related distribution. It is a broad net, but it doesn't include everybody. And there's what it lists right there, who qualifies. Those that are diagnosed with the virus, those whose spouse or dependents are diagnosed, those who experienced certain adverse financial consequences, furloughed, laid off. What's interesting is it could be anybody in your household that experienced these situations. It doesn't have to be a spouse, it doesn't have to be a family member, it could be a roommate. If anybody in your household, and that's what it says in the bottom there in blue, member of the individual's household is someone who shares the individual's principal residence. It could be a friend, partner, etc. So a broad net, if anybody in your household, your spouse, or if you experienced any of these situations, you qualify for a coronavirus-related distribution. If you took a distribution last year and you didn't put it back and you want to put it back, you can deem it a CRD and it can go back and you can eliminate that income. So it's kind of a catch-all for anybody that did that, but you got to fit into the affected individual category. If you do claim a CRD, you have to file this form, IRS form 8915E. So if you say, you know what, Andy, that's a good idea, I'm going to do that. I'm going to deem that distribution that I took last year as a CRD. You simply fill out this form. It says, yep, that was a CRD, and now I'm paying it back. So that's on the same form 8915E. So just be aware of that. If you do go down that avenue of deeming a prior year distribution as a CRD, 8915E is the form that you have to fill out. Okay, next slide. This is a biggie. QCD reminder. A qualified charitable distribution will not be coded as such on the 1099-R. So this is another tax issue to be aware of. There is no code for a QCD on a 1099-R. If you do everything perfectly, if you say, hey, Mr. Custodian, I want to give $10,000 to my church as a QCD, and that money goes directly to the church, and you've done that perfectly, and you get a receipt from the church, and you say, all right, my QCD is done. The 1099 will be sent to you, and it'll simply say normal distribution. And if you give that 1099 to your CPA, there will be no indication to that CPA that you did a QCD. So that's why communication is absolutely key. You have to tell the tax preparer, this was a QCD, here's my receipt, make sure this is reflected properly on my tax return. So that's a big one. Next bullet point says, does every QCD reduce an RMD? It doesn't. A lot of people fall into the trap of thinking that if you have a required minimum distribution, you can only do a QCD up to that amount. That's not true. Regardless of what your RMD amount is, you can do a QCD annually up to 100 grand. So just because you might have done you might have had a $10,000 RMD or a $15,000 RMD, you can do a $40,000 QCD if you want to. It doesn't matter. You're not limited by the amount of the RMD. Next bullet point says do it early and then no retroactive QCDs. Those kind of are synonymous. If I take a distribution from my IRA account in February and I take $10,000 out, and then 6 months from now, I say, you know what? I want to go ahead and deem that distribution back in February as a QCD. Can't do it. You can't retroactively call a previous distribution a QCD. I can do another distribution as a QCD, but it would be over and above what I already took. So we recommend do your QCDs early so you don't fall into that trap of taking money and then having to do more money on top of it as a QCD. And the third bullet point on this thing is nuts. The Secure Act elimination of age restrictions for deductible IRA contributions. Did we create a taxable QCD? So the Secure Act, as it says, eliminated the age restriction for deductible IRA contributions. If you have earned income, and let's say you're 74 years old, you can contribute to an IRA. That used to not be the case. You used to be cut off at 70 and a half. Here's the problem. You can't take advantage of both a deductible IRA contribution and a QCD. The IRS says that is double dipping. So you can't do it. What happens is if you make a deductible IRA contribution after age 70 and a half, that will sit there and basically hang over your shoulder as like a cloud. And then let's say 10 years from now, you do a QCD, the amount of that deductible contribution will offset a chunk of that QCD. So if you do a $7,000 deductible contribution to an IRA right now and you're over the age of 70 and a half, and then 5 years from now you do a $10,000 QCD, that $7,000 is going to hang out there and then come forward, and 5 years from now it's going to carve out $7,000 of that QCD and make that taxable on that QCD. So bottom line, don't try to do them together. If you're going to be over 70 and a half and you're going to be doing QCDs and you also want to make a contribution to an IRA, we recommend just do a Roth IRA. It makes it easy. You can't, the deductible contribution is going to mess up the QCD. So why do a non-deductible contribution to an IRA? You just do it to a Roth. So keep that in mind. QCDs and deductible contributions after the age of 70 and a half do not mix well. Here's one that has been having our phones ring off the hook. 1099-R issues, rollovers, and returned RMDs. We know that the CARES Act waived RMDs for 2020. While this was welcome, it created potential confusion. So a lot of people that had their RMD payment, they put it back. They said, hey, I've got the RMD payment. I don't want it. It's been waived. I put it back, wash my hands. I'm done with it. Putting the money back does not eliminate the fact that it was originally paid out. That last bullet point says, thinking everything had been zeroed out after repayment, IRA owners might be surprised to discover that Form 1099-R still shows the RMD as a taxable distribution. All these people that never did a rollover before have just done a rollover. They took the payment and then they put it back. That's a rollover, and you have to report it properly. It doesn't just make everything go away. You have to report it on your taxes. So if you did that, you will get a 1099. It will show a distribution. But this is how you fix it. You have to indicate on your taxes that it was a rollover. So on Form 1040, it says right there, line 4A, you indicate the amount of the IRA distribution. Let's say it was a $15,000 RMD. Paid it out to you. That's going to show up on a 1099, $15,000. On line 4B, it asks you how much of that was taxable. You write 0. And then it says you write in rollover. It's really a drop-down box nowadays on these electronic filing forms, but you put in rollover. So now it's going to show a $15,000 payment on the 1099-R. You're going to show 0 of it was taxable as a rollover. How do you prove it? A 5498. That form comes out later in the spring. You don't need it for your taxes. It'll be sent to the IRS. The IRS will get your tax form. It says, hey, Mr. Smith says he did a rollover. We've got a 1099 that says it was paid out to him. He said it's not taxable. Let's wait for proof. Later in the spring, early summer, the IRS gets the 5498 from the custodian and says, yep, everything matches up. They put them together and you're good to go. Just don't wait around for that 5498 because it's not going to come for a while. Once again, you do not need it for your taxes to report this rollover properly. Okay, here's one pro rata rule, keeping up with tax reporting, all the things that are going on, and making sure that we're doing things properly. Basis, claiming your basis, meaning claiming your after-tax dollars in your IRA. If you make a non-deductible contribution to your IRA, some people talk about the backdoor Roth. If you want to talk about that, you can talk to Joe and his team. Doesn't fit for everybody, but that buzzword is out there. If you put a non-deductible contribution into your IRA, you have to tell the IRS that that money is after tax. And you do that with Form 8606. 8606 is basically a bullhorn to the IRS that says, hey, I paid money on these tax money on these dollars in my IRA. And this is how you track it with Form 8606. So be wary of that, because if you don't file Form 8606, when you take a distribution or when you do a Roth conversion in the future, that money will get taxed again because the IRS has no idea that it was with after-tax dollars that you put that contribution in there. So 8606 is key for non-deductible contributions to IRAs. The bottom of this page talks about the pro rata rule. I am not going to get into the weeds on that. Certainly Joe and his team can talk about that. Basically, since I mentioned backdoor Roth, I'll go into it. Some people don't make too much money to contribute to a Roth directly. They're not eligible for Roth for whatever reason. So they contribute to a traditional IRA, and then they convert it to a Roth IRA. That is a backdoor Roth. The problem that people get into is you cannot cherry pick the dollars that you want to convert from the IRA to the Roth. Meaning, if you got a bunch of money in your IRA that's pre-tax and you do a $7,000 non-deductible after-tax contribution, you can't just say, convert the $7,000. You can't cherry pick those $7,000. Pro rata rule says you have to look at the ratio between pre-tax and after-tax. Every conversion will be a proportionate amount of pre-tax and after-tax dollars that are converted, and that's what you have to pay tax on. So it can get a little bit convoluted. Once you get the nuances of it, pro rata is not that difficult. Just be aware that you have to consider all of your IRAs. You can't just say, my IRA with custodian A is my after-tax dollars. My IRA with custodian B is my pre-tax dollars. I just want to convert this one over here of my after-tax dollars. Can't do that. The IRS looks at all of your IRAs, all of your SEPs, and all of your simple plans. All of those dollars are considered one bucket in the eyes of the IRS. So be wary of that. Be wary of that when you're doing these conversions. NUA is net unrealized appreciation. That's more of a forward-looking tax item. If you have a 401k plan that has company stock in it, before you just go ahead and blast all that money over to an IRA as a rollover, think about the net unrealized appreciation. There's a way where you can pay ordinary income only on the basis, on the acquisition cost within the plan, and then you can take all the appreciation on that and pay long-term capital gains. So instead of rolling everything over to an IRA and then taking out later on and paying ordinary income on the whole thing, if you're smart about it and you fit the NUA scenario, not everybody fits, but if you fit, there's a possibility to certainly reduce some taxes on that. Next slide just talks about the flow chart of how NUA works. We won't get into the weeds on that. I wanted to get to this one right here. This has been a hot button issue. Babysitters, driveway shovelers, and lawnmowers. I know a lot of kids out there are doing these things, shoveling a lot of driveways. And people say, hey, my grandchild has earned income, quote unquote earned income. Can I make a Roth IRA contribution for him or her? Yes, but it must be legitimate income. That child can't just go shovel driveways all winter long and make $5,000 all under the table. Hey, everybody's giving him 20, 50 bucks every time he does it every week. And then he can't just say, okay, I've got earned income. He's got to claim those, he or she has got to claim those dollars to make them legitimate earned income. That can be done by filing a tax form for that child. It seems kind of strange, but you have to do it. You have to pay those taxes. Technically, if you get into the weeds, if a certain amount of money is paid to a child for work, the homeowner has to give that kid a 1099. There's all kinds of crazy tax rules, but if you think about it, our tax system is based on the honor system. You have to claim those dollars. There's no such thing as under the table. There is, but technically it's not supposed to exist. You have to claim those dollars if you want to contribute to a Roth. So if we get back to the child who shoveled 1 million driveways and mowed 1 million lawns and made $5,000, if he or she goes ahead and claims those dollars, files a tax return, and pays taxes on those dollars, nothing then stops the grandparent or the parent for saying, you know what, little Johnny, you keep your 5,000 or whatever's left after taxes. I'm going to make a contribution to your Roth IRA for you for 5,000. That will certainly count against the annual gift exclusion, but you can absolutely do that and contribute to a Roth IRA, because now the Roth IRA door is open because that child has earned income. So a number of different things we hit on there, from QCDs on the 1099 to rollovers, from deeming distributions from last year as CRDs. There's a bunch of different ways to potentially reduce income for 2020, as well as ideas of things to avoid and potential pitfalls along the way. As Ryan was saying in the beginning, make sure to check with your advisors as well as your tax preparers before you jump into any of these things, because certainly there's a lot of pitfalls and potential out there. At that point, looks like we're about 25 minutes in. I don't know if you have any questions here for us, Ryan.
Yeah, Andy, thank you very much. That's excellent stuff that you provided there that we need to go over with our accountants. There are a couple quick questions, if you don't mind, from our gallery today. One comes from Cliff, and forgive me on the last name here, Cliff, Giese. It's going back to that spousal contribution, right? If you got one of those wage earners, we get a lot of this from our clients here, and we utilize this a lot. But he's saying here, if I make $5,000 and I put $5,000 in a Roth, my spouse cannot put money in a Roth if she had no income. Am I correct? Can you help clear up some of that?
Yeah, Cliff, you are correct. If you make $5,000 and that's all you made, your max cap is $5,000. That's all you can put into your Roth IRA. Once you've depleted the 5,000 in yours, you can't double up or put anything else into the spouse's. Now, let's say you made 15,000. You will hit your cap at 7. You still have another $8,000 left over. That can be used to fill up the spousal side. Hypothetically, if you made 10,000, you could put in 7,000 into yours and then 3,000 into the spouse's. So again, it's all about the total that you made compared to the total that goes into the two different IRAs.
Correct. Thanks, Andy. And then one last question here from Tim Covey. He says, can you pause your RMDs during the year using a QCD?
Good question. You can't pause them. You can offset them. Meaning, let's say it's 2021. RMDs are now back in effect. My RMD for this year is $12,000. I can't stop those dollars from coming out, but I can reduce them or eliminate them from my income by doing a QCD. So instead of me taking that $12,000 RMD and paying ordinary income, I do a QCD for $12,000. That money doesn't come to me. It goes directly to the charity that I've requested the custodian to send it to. And now I have eliminated that $12,000 from my income. So it still had to come out. My RMD wasn't paused. The RMD money still came out of the account. It just didn't come to me. It went to my charity. So now that $12,000 does not count in my income for the year.
Yeah. Yep. Uncle Sam does not like pausings of the RMDs, man. He wants his money. But Andy, thank you so much for being with us today. And thank you for our listeners that took time out of their day to be with us. Again, you guys know where to find us. Your secured retirement team is always here for you. We'll get back to you as soon as we possibly can within the end of the day. Reserve your reviews. We've got RMDs. We've got all this stuff coming back into play now. So it's never too early to start talking about it. So get a hold of your advisor. We'll be glad to get you in here for a review or analysis or whatnot. Again, our phone number, 952-460-3260. Andy, thank you very much. You have a great rest of the week, and we'll see you soon.
All right. Thanks, guys. Appreciate it.
Thank you, everybody. Have a great day.